Yep, what's going on? So today I'm just going to be kind of simplifying or sharing to you how to fully comprehend and understand what Wick theory is and how I sort of derived my own standalone model, and I call it Kaz's model or Wick theory. But the original concept or idea was publicized by ICT, so credit is given to where it's due, and I kind of created my own remediated or standalone model that works a lot better for me. But basically, I was in a call yesterday with a student and we were just back testing a bunch of price. And he saw how I was utilizing Wix to sort of build narrative or bias, and he had no idea how to do that. So I wasn't going to send him a bunch of ICT videos of tedious content to sit through. So I decided to jump on here and just sort of explain the simplified or way easier version of how to comprehend a simple concept. But basically, in order to understand Kaz's version of wick theory, you must understand what wick theory is itself. And wick theory is reading every single wick as a gap in price. So essentially, you're anticipating every single wick in price action as as a fair value gap or just a gap in price. Now, what does that mean? So price utilizes fair value gaps as a point of interest for institutions to offload positions, and wicks literally work the exact same way. So imagine this. Every single fair value gap is a point of interest for what? Entries, because it's where institutions are stacking positions or offloading positions. There's no in between. The two reversal points for price all the time is highs and lows and inefficiencies. So inefficiencies, that's pretty vague, right? So inefficiencies is what? A fair value gap. It's your opening range gap. It's your first presents a fair value gap, obviously. And now it's your wick gaps as well. So wicks are just a point of interest, and it's fractal, of course, but the minimum time frame that I use it for personally is the M15. I don't like anything sub the M15 just because every single wick and price just gets pretty messy. All right, so I went ahead and I drew out a quick image of just a candle. This could be any time frame, whether it be your weekly time frame, your daily time frame, your 4 hour, your 1 hour, your 15 minute, 5 minute, 1 minute, anything. Essentially, you're literally just taking what you're taking the wicks, and just like you would mark out your fair value gap, you just mark it out as a fair value gap. And you'd wait for what? You'd wait for the next candle to either trade into it, either super OTE level, which we'll dive deeper into that, or you just wait for something like this. You take your quadrants, just like you take your quadrants on every single fair value gap, and you see how price is reacting. You'll see how price is reacting to what? The lower quadrants if you're bearish, and if you're bullish, the lower quadrant or the upper quadrants of the lower side of the wick. But yeah, it's literally just how you read it. It's just like a fair value gap. You mark out CE. You realistically don't want to close above CE. Another way that you could use wick theory is that you take the OTE or optimal timed entry for each wick. So essentially what you're waiting for price to either trade into 0.5, or you're waiting for it to respect or tick any one of these levels, whether it be your 62, 7.05, or your 7.9 level. You're waiting for it to soup one of these levels, and that's whenever you're looking to get in, right? The second that they see it soup or respects or tick one of these levels and it's respecting it, they just get in with stops at the high or the low. And now that you guys understand the derived concepts of wick theory, the originality of it, we can get into Kaz's, or how I personally interpret it, or how I personally utilize it in my everyday trading. All right, so this is kind of Kaz's model, or the way that I personally use wick theory, and I don't use it in the typical sense. It's a three-wick sort of type of model, and you're getting it on the third wick. Same with buys and sells. So essentially, this is all that you're looking for. You're looking for a higher time frame pity array, whether it be a H4, daily pity array, order block, fair value gap, rejection block, breaker block, anything works, right? You're gonna mark it out third wick to, because after you type into a higher time frame pity array, guess what? After you have two consecutive wicks that look just like this, you're going to take out the longest wick that either swept out any type of liquidity or just created this three-wick pattern, and then you're waiting for it to get traded right into. And that's kind of the whole idea of it. We're going to run into some more examples with the actual charts, but that's kind of the way that I use it. It's really simple. It has a really good hit rate as well, so You could also do something like this, where you're waiting for a level to get souped, and then you jump on a lower time frame, and then you utilize that for your entry. For instance, you could say it souped the 0.62 level. You would have been in right here at the 0.5, stops at 1, targeting low-hanging fruit or objective. And guess what? The largest candle that's right next to the two consecutive ones, you enter right off of the top of it. That's what I personally do, and then what stops below. Or you could wait for what? The consequent retracement and enter off of there what stops below the one. But in my personal experience, I've seen more times than not that will trade literally to the upper quadrant. So you're safer off just entering at the high or the low this wick, and then you just with targets being low hanging fruit. Again, you could utilize what as well? The OT levels of this range. So for instance, this wick could have souped the 7.9 level, 7.05 level, or the 6.2 level, could have souped any one of these levels before continuing higher, and that's still valid as well. Now we're going to jump into some live price action. These are some personal examples that I've personally taken. I'm just sort of breaking them down to you. But right here, you guys see this three candle model right here? Right here, we inverse the fair value gap, right? We inverse it with this candle. You wait for the next candle to trade back into it, and then you wait for the third candle. You see 1, 2, and then you're entering off the third candle right here. So this would have been your exact entry. So the second that we inverse and we trade back into it, we wait for the next candle to trade back into it as well. 2 consecutive candles, always remember that. And this becomes what? This becomes a gap. So you have 2 inefficiencies or balances now that you could use to enter. And you could have even taken what? The OTE, this range. Look what it does. It literally soups the 7.9 level to the T, and then it just flies up. So this would have been your long-term hold for what? For these highs right here. But me personally, this is the position that I would have taken. The second that we trade up into it, I would have been in on this candle actually with stops. Because 9 times out of 10, it's super duper hard, and it's, for me personally, it's not worth the mental headache to try to soup the exact lower high of the move. As long as I can get in with minimal drawdown, knowing that if it gets taken out that I'm wrong, I don't mind being in a little bit of drawdown personally, but you could have waited for the OT retracement, taken that as well, and you would have been targeting these highs right here, which is, this play is at least still concurrent, like it's still going. And we'll dive into the next example, which is right here. Is that a volume imbalance? No, it's not. But right here, look, we tap into a what? Higher time frame PD array. What does this make this wick right here? This wick trades into it. So we're taking the OTE of this range. And look what happens. Respects the upper quadrants, and you would have been in on this candle. Again, another trade that I would have taken. Would have been in right here. Stops at the 1, because there's no reason for it to go back below that low. Targeting what? These highs right here. Again, another concurrent live play that you could have taken. And I believe this was a lot cleaner on the H1. So let's play this out real quick. Right here, you have a BISI, or buy side inefficiency, sell side imbalance. You would have waited for what? You would have waited for the 3 candle model to form. So it formed right here actually. And then again, it formed right here. So there's 2 times that it formed. That's 2 trades that you could have taken straight to take profit for relative equal highs. So right here, look, first candle trades into it, second candle trades into it, largest wick, you're in on this third candle. Always take the OT of the largest candle. Look what we're souping, the 0.5. Long entry criteria would have been right here, take profit right here. Entry, straight to take profit within the same day in the 2-hour range. And then again, it forms right here. We're tapping into it, fail to touch it to this wick. This gets wicked out. We tap into it right here. What makes this wick right here? An imbalance, right? So you're getting it on this candle right here. You could either wait for an OTE retracement, which right here, we do get an OTE retracement. Failed to hit the 62 level though, but we still gave discount pricing. But I would have been in the second that we trade into it. I'd have been in there, stops at the low, targeting what? These highs. Again, straight to take profit. And those are just a couple of examples of Kaz's model. This is an ongoing phenomenon. It literally happens every single day on your charts. If you guys don't believe me, literally look for it yourselves. And I kind of just gave you guys a breakdown of wick theory, Kaz's model to wick theory. And if you guys have any questions, again, the Discord link is going to be in the description. But yeah, if you guys like content like this, you guys know what to do. Like, subscribe. Join the Discord for any questions. And yeah, peace.